Now, we know that management, they prepare the financial statements. They are responsible for these numbers. Management, they are also responsible for their internal controls. And we know that the external auditors, the independent external auditors coming from outside, they look at internal controls, they express an opinion on these financials. Under the provisions of the Sarbanes-Oxley Act, as per the Public Company Accounting Oversight Board auditing standards, auditors are now required to have an integrated audit of financial statements integrated with an audit of internal controls over financial reporting. They do two audits, express two opinions. First on the financial statements, second on the internal controls over financial reporting. So that's about the external auditors. Now let's talk about internal auditors. So internal auditors are the guys who work for the management, who ensure that there are good internal controls. That means internal controls are designed and implemented effectively. Now, we know that if internal controls are good, they would ensure fair and accurate financial accounting and reporting. They would ensure compliance with laws and regulations. They would ensure effective and efficient business operations. So all these were the objectives of internal control that we learned. Now, when we did internal controls, we also talked about the components of internal controls, and we said it's a crime for the management not to have proper internal controls. Now, the M of crime, monitoring, that in a lot of ways is the job of the internal auditors. Now, under E of crime, existing control activities, we had authorization, recording, custody, comparison and segregation of the duties. Now, the second C, comparison, that again looks like a good job for internal auditors. So guys, as you can understand, internal auditors, they are responsible for making sure internal controls, they're good. Now, if internal controls are good, the probability of failure of internal controls, that's going to go down. Think about it. So let's get back to the risk formula that we started this section with. So we said risk is equal to the probability of threat multiplied by the probability of failure of controls multiplied by the dollar amount of loss. Now, if the probability of failure of controls is reduced, it becomes zero. Let's say it comes down. The risk of the management, the entity's risk, that's going to come down. And that's basically, in short, the job of internal auditors. On page 21, we're looking at the responsibility and authority of the internal audit function. So the internal audit standards are established by, put a box around, Institute of Internal Auditors, IIA. Highlight IIA's standards. Now, they fall into three categories. The first one, highlight attribute standards. So these address the characteristics of organizations and parties performing internal audit activities. They provide guidance in the areas of purpose, authority and responsibility. Internal auditors, they should be independent and underline objective. They should have underline proficiency and should exercise underline due professional care. The attribute standards also talk about quality assurance and improvement programs. So you can put a bracket around all those areas and write these are characteristics of internal auditors. Next, we got highlight performance standards, which describe the nature of internal audit activities and provide quality criteria against which the performance of these services can be evaluated. So they provide descriptions of activities that internal auditors should perform and indicate appropriate levels of quality in these areas. So it talks about managing the internal audit activity, engagement planning, performing the engagement, communicating results, monitoring progress, and resolution of management's acceptance of risk. Now, put a bracket around all these areas and write nature and criteria for internal auditors' work. Now, the third category of standards highlight implementation standards, which provide more specific guidance on underline how particular attribute standards or performance standards should be applied within different types of engagements or activities. Turn to page 22 and put a box around reporting internal audit results. Now, audiences of the internal audit report include divisional and operational managers as well as top management and the board of directors. Now, the internal auditor should inform management of all problems, and they may need to consult legal counsel before highly sensitive information is included in a written internal audit report. The internal auditor's report identifies conditions as highlight findings, which are performance or actions as measured against the firm's policies, procedures, standards, or external laws and regulations, and against risks such as inadequate safeguarding of company assets. Now, the findings may be positive or negative. Negative findings, they are called underline exceptions. Now, there should be underline a summary findings sheet which reports the condition and the policy, legal criteria or expectation regarding each finding. The report should include conclusions regarding both the effect of the condition and its cause, along with recommendations on the control objective for each finding. Now, the auditor, they can make 4 types of highlight recommendations. So, they could say underline make no changes. So, if the audit determines that the activities investigated do not represent any significant problems, then the auditor will recommend no change, but may seek an exception to the standard and instead submit an analysis to the management. The auditor could recommend to underline modify internal control policies and procedures. So, the audit report should recommend changes in the areas of risk or poor performance. The recommendations should identify what needs to be achieved by the change and leave the details and tactics to the management. The recommendations should provide details clearly and succinctly. They should be fully supported by evidence. They should be action oriented and achievable with reasonable deadlines and resource commitments. The internal auditor can also recommend to underline add insurance for potential risks discovered during the audit. So, the auditor may suggest insuring against the liability involved rather than suggest new policies or procedures to address a potential risk. So, insurance, it must be cost effective, practical and an ethical strategy. The internal auditor can also underline adjust the required rate of return on an activity to match the associated risk. Now, in light of the organization's risk appetite, the auditor may report that the activity involves more potential risk than is justified by the current projected return. Moving to page 23, we are looking at the internal auditors put a box around audit evidence. These are gathered by the internal auditor, right, to support findings. Looking at the types of evidence, highlight primary evidence. So that's evidence gathered underlined by auditors by observation, surveys, interviews, inspection of documents. Next, highlight secondary. So, secondary evidence is gathered and submitted underlined by the subject of the audit or underlined by third parties. Now, the auditor assigns credibility to this evidence according to their assessment of internal controls relevant to it. So, if the internal controls are weak, the auditor would require more corroborating evidence. Next, highlight circumstantial. So, circumstantial evidence is a set of underlying conditions that make one suspect the existence of a particular problem. And they could also highlight analytical evidence, which includes such things as underlying financial ratios and underlying vertical and horizontal financial statement analysis. Now, analytical evidence can be useful in testing the success of financial operations in supporting corporate objectives. On the next bullet, put a box around controls against fraud. Now, the internal auditor is responsible for examining the controls to determine if they are adequate to prevent or detect fraud. So, underline prevent, circle or, and underline detect. So, we are looking at frauds from misstatements or highlight fraudulent financial reporting. So, that's like, right, lying. Next, it could be fraud in the form of highlight misappropriation of company assets or right stealing. It could be highlight corruption, bribery, conflicts of interest, right there, cheating. Now, the auditor must also have sufficient knowledge to be able to identify the indicators that fraud may have occurred, whether it's lying, stealing, or cheating. Turn to page 24, where we got types of audits which can be conducted by internal auditors. So put a box around financial. So the objective of a financial audit is to determine whether the overall highlight financial statements, they fairly and accurately represent the company's operations and financial position. Next, put a box around operational. So an operational audit helps evaluate the effectiveness and highlight efficiency of a business or a division. Next, we got put a box around performance. So performance audits examine the highlight performance of a specific division. Next, put a box around information systems. So an information systems audit helps evaluate highlight efficiency as well as the security of the organization's information systems. Put a box around contract. So contract audit examines the conditions and legality of highlight legal contracts, including those with supply vendors and contractors. Put a box around compliance. So a compliance audit helps determine whether the firm has highlight complied with all applicable laws, regulations and professional or industry standard. Put a box around special investigations, which are done to investigate highlight special situations or problems. For example, suspected fraud. Next we got put a box around lines of defense. Now an organization has multiple lines of defense to protect themselves from risk. Right, so the first line of defense is the organization's highlight managers. So the managers, they own the risks and it is their responsibility to control them. The next subbullet, right, second, highlight staff departments. So staff departments are the second line of defense who carry out the control procedures and policies. Right, third, and that's where we have highlight the internal audit function.